and welcome. Today we'll be discussing how to invest for the longer term. I'm Molly, an event planner here at SoFi, and I'm excited to introduce and chat with certified financial planner and senior manager of our financial planning team at SoFi, Brian Walsh. Welcome, Brian.
Thank you so much for having me.
Absolutely. In our last video, we realized that a short-term goal is 0 to 3 years. What classifies a longer-term goal?
Yeah, so at a high level, as we're thinking about our financial goals, really a long-term goal is going to be anything that's more than 7 years out. So a lot of times what we think about as common long-term goals would be retirement, maybe saving for a kid's education, maybe buying a house, things like that. We're really looking at goals that are going to happen further down the road because the core here is that we're going to give our time money to grow as we start saving and investing towards that future goal.
Absolutely. Can you help us understand some mindset rules or other helpful habits to impact long-term prosperity?
Yeah, in my mind, there's going to be two helpful habits that really impact the success of achieving long-term financial goals. The first one would be kind of keeping in mind that volatility is normal. The ups and the downs of the market are going to be normal, and we should really be focused on that balance decades from now, not days from now. Because when we focus on short-term fluctuations, we could be tempted to make bad decisions, like selling at a low or things like that, and we're all guilty of it, even me. The other thing that comes in mind that's a very helpful habit is truly automating what you need to do, and that's going to be recurring contributions, saving towards your goals, and also automatically increasing those contributions. So that way you can be saving now and saving even more in the future. That's really going to build and snowball towards achieving those long-term goals.
Awesome. Now that we know what some of the healthy habits look like, how can we begin to think through and determine the type of financial future we might want?
You know, it's kind of funny. Everyone's financial future is going to be as different as they are. At a high level, everyone's going to have a unique version of financial freedom, things that they want to accomplish. Sometimes that may be traveling. Sometimes it could be seeing family. Sometimes it could be going on fancy vacations or whatever it may be. At the end of the day, a good starting point is to focus on maintaining your current lifestyle. In order to do that, you should just focus on saving between 15 and 20% of your income towards retirement. Essentially, that's going to be kind of that baseline target in order for you to live the same lifestyle you have now once you stop working at some point in the future.
Absolutely. Brian, what do you think is the biggest issue folks run into when trying to successfully plan for their long-term goals?
Yeah, I think, the time frame that you mentioned is just that issue. It's long-term. A lot of times when you think about long-term goals or objectives, on one hand, they're so far away, which is amazing because your money has time to grow. But on the other hand, they're so far away that sometimes they don't seem real. And it seems like you could always just catch up or save later. And really at the end of the day, when it comes to investing or achieving your long-term goals, time can either be your best friend or your worst enemy. If you start saving early and you make it a habit and you start building towards it now, time becomes your best friend because of compounded growth. If you delay and let's say wait 5, 10, 15 years to save, then time becomes your worst enemy because you don't have enough time to make up for the money that you didn't save.
Speaking of time, how should your risk tolerance evolve as you age?
Yeah, generally speaking, as you get older and as you get closer to using your money, that's going to be ultimately where you start taking a little bit less risk. The period of time of basically, let's say 5 to 7 years before retirement and 5 to 7 years after retirement, that's really kind of like the danger zone when it comes to not only making it to retirement, but making it through retirement. So generally speaking, people tend to take a little bit less risk as they get closer to that danger zone, so that way they can make sure they're experiencing less ups and downs, and their money's going to make it all the way through their long-term retirement.
Now let's zoom out a little bit. How would investing for retirement differ from other longer-term investing goals? Say I want to buy a house in 10 years, but I also want to plan for retirement.
Yeah, so there's going to be several key differences when it comes to investing for retirement versus investing for long-term goals. Number one, the type of goal that you're investing for should influence the type of account that you use. There are specific accounts that are designed to be used for retirement. Think a 401k, traditional IRA, Roth IRA. And then there's specific types of accounts that are designed to be used for education savings. Let's say a 529 plan. So choosing the right account is going to have a big impact on your long-term investing. Also, there's a difference between using money for retirement and using money for, let's say, buying a house in 10 years or paying for your kids' college. And that's when you start taking money out, how long are those distributions going to last? So that should also have an impact over how you're investing money now, and then how that investing approach changes over time.
I know I learned a lot. Thank you so much, Brian, for helping us walk through our long-term investing options. Thank you to our SoFi members joining us today, and we hope to see you back at another Financial Fireside Chat soon.
Yeah, thanks for having me.